Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Fed gives us a surprise rate hike, but the market doesn't stop going up because of it. We'll get people here at the roundtable to react to that and a couple of other things, as we hear from our editor-at-large, Steve Reitmeister, Director of Research, Shiraz Mian, and that market technician, Kevin Matris. So I found that to be kind of interesting, but there's actually two issues here, so let's take them one at a time. Steve, what about this discount hike, this rate hike here in the discount rate? Is that just the beginning of the exit strategy that's being put in place? It's the beginning, but I think far too many people initially felt that meant that everything else was going to come in lockstep in the weeks to come. And the thing is, they keep calling it a surprise rate hike. It wasn't a surprise at all. If we go back a week and a half ago to when Bernanke put out his minutes, he clearly said, in my bag of tricks, here's some of the things I'm going to do. The discount rate is artificially low. It needs to go higher. He already made it very clear this was what was going to happen. And just to put it out, traditionally, the discount rate is about a full point higher than the Fed funds rate because it's supposed to be the rate, that's supposed to be the emergency window. Right. Okay. And so now it's just about raising it back up to its natural place, but it's not necessarily a signal that the rest, the Fed funds rate and the rest of it is going to fall behind, is going to take place immediately. It's an emergency rate. So, Kevin, does that mean the emergency's over?
Well, I don't know if the emergency and the crisis has lessened considerably, but the discount window has always kind of been the lender of last resort. There's fewer people going to the discount window, but nonetheless, as Steve had said, the Fed has already broadcasted that this was part of their reining in of some of these stimulative policies. But if in fact it's true that the discount rate is typically on average a full point above the Fed funds, you literally have probably another 50 basis points for it to go before the benchmark is even going to budge. And Bernanke was very clear, saying that he has zero intention of being able to move on rates for any time soon because he needs to be able to foster growth and they have to do something about jobs. So I don't think the benchmark is going to move anytime soon. All right.
So, Shiraz, you don't even think that this indicates, this is not a signal that we're going to start seeing rates go up across the board here by the end of the year, maybe?
If it's a signal, it's a signal of the fact that the Fed and its Open Markets Committee and overall the policymakers are more comfortable with the normalization of the underlying economy. So they don't need this extraordinary measure to be still out there, available to banks, instead of the routine overnight market, which is the Fed funds market. Mm-hmm. So like Steve rightly mentioned, historically, it's been 100 basis points above the Fed funds rate. There's been a stigma attached to a funding institution going to the discount window. So in order to encourage them in the depth of the downturn, late 2008, early 2009, the Fed reduced the spread, right. And there was evidence that we were in very extraordinary liquidity situations in crisis. The Fed now moving in the opposite direction is an acknowledgement that the underlying economy is far more normal and stable. As you guys touched upon, is part of the exit strategy of removing some of these extraordinary stimulative measures that were put in place in response to that.
All right, so basically, message is if you need credit, don't come to the discount window. We got that. Now, as far as the stock market is concerned, the market had a little bit of a difficulty interpreting this news. I mean, it came apparently overnight, so it came as a surprise to the market. But you mentioned the normalization of the economy, the normalization of interest rates. That's what we're moving toward. So do you think the market, Steve, is going to be content with watching rates just drift higher here?
Well, here again, if you know these things beforehand, you can't say it's a surprise. You can move your investment strategy accordingly. A lot of people say that a raising rate environment is not that good for the stock market, but that's not really true. If you take a look at most extended bull market cycles, there is a lot of period of time where there is not accommodative Fed policies, okay? And so it going up, it makes it a little bit trickier, but the economy can continue to expand while the Fed moves moves the rate back to a normal standpoint of 3.5%, the economy still should be able to expand, increasing corporate earnings and increasing the what should be the valuation for the market. So I don't think this is going to be any scary event.
Okay. Report out today by the National Association of Business Economics that economists by and large agree that the recovery is firmly on track. Now, what I found curious was kind of some mixed signals here, because these economists are saying that the recovery is going to be led by businesses. However, last week we got another reminder that the job situation is not so good when initial claims took a hike of 31,000 in the latest reporting week. Shiraz, how are you reading this?
I do not see any inconsistency in both of these data points. We all now see the economy growing, maybe not at as robust a rate as we saw in the fourth quarter. We saw 5.7% growth rate, so it's definitely moderating from that level. But the labor market is the one laggard metric that we are all concerned about. So we should see consistent growth, but the slack in the labor market will continue. So I don't necessarily see any inconsistency in both of those data points. Visibility on the broader economy is improving, and that's what you're showing in the consensus estimate from the economists.
Right. All right, as long as we're talking to you right now, oil flirting with $80 a barrel again. Is this a good thing?
To the extent that it shows that visibility on the global economy is improving, it's a good thing. On the flip side, it's a cost for the consumer, for a lot of industries. So whether it's the retail sales, whether it's disposable income for consumers, whether it's the transportation sector, whether it's the airlines, it's an input cost for a whole bunch of sectors in the broader economy. So in that respect, it will be a hindrance to growth.
But Kevin, this rise to $80 a barrel or right around there comes with the country still being flush with large inventories.
You know, it's interesting. I think early in the year we were talking about what we saw, thought was going to happen to the price of oil. And I think at that time it was probably somewhere around like maybe $70, $75. And I think there may have been a consensus here, but I know for myself, I was saying that I thought that oil would hit $100 before it hit 60. And if you take a look at where oil prices are right now with, nowhere near as much demand as we had a couple of years ago, and we are seeing, an increase in supplies, if we are looking at $80 a barrel right now, imagine what's going to happen as we do see the economy, not just here in the States, but around the world continue to improve. I really do believe that we will see the price of oil get closer to 100 before we see that $60, because I do believe demand is just going to continue to creep higher.
Steve, rising oil a negative for the stock market?
They have a strange relationship to each other. If the economy is getting better, it increases the demand for oil, and a higher demand should, versus demand-supply relationship, that should equal a higher price. It's when it gets to an extremely high price, when you push over 100 as we did previously, and because oil greases so many parts of the economy that it becomes, as Shiraz said, a hindrance. Because of such a high cost of doing business. So right now, we as a people can swallow $80 oil, given the current economy. It's we can creep a little bit higher. If we start pushing over 100 again, without really the economy going gangbusters, people will be talking about how this is curbing our potential growth.
All right, that's the latest thinking from the roundtable. We thank you for joining us, and we hope that the week ahead for you is a profitable one. With everyone here, I'm Terry Ruffalo.